Hey everyone. Upstart is a lending platform infused with artificial intelligence that they use to make lending decisions. Unfortunately, Upstart stock is down 87.8% off its high. In this video, I'm going to look at the stock and answer if I think it's a buy heading into 2024. Now, Upstart is an interesting stock to be sure. It's got a couple of things going for it. Number one, it aims to be a platform that brings together borrower and lenders, and that's a business model that I generally like to invest in. It also uses artificial intelligence to make lending decisions, which could be a better method for making lending decisions compared to legacy methods. So it's a lot to consider. Let's jump right in. Let's look at the details and answer if Upstart stock is a buy for 2024.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So I already mentioned that Upstart aims to be a platform that brings together borrowers and lenders and takes a fee for the transactions on the platform. I like that kind of business model. It's similar to what I see in eBay, in Etsy, in Airbnb, and these are all stocks that I've recommended as buys because of that buyer and seller taking a hands-off approach and just creating a platform and taking a fee from each transaction. The problem with Upstart recently has been the increase in interest rates started by the Federal Reserve, the central bank, has made it more difficult for Upstart to run that business model. It was forced, well, it wasn't forced, but it chose to step in and make the loans itself. And that's where I became hesitant with Upstart. That's when I first became hesitant with Upstart stock. Initially, the idea is to bring together borrowers and lenders and for Upstart not to use its own money to make loans, right? It was supposed to be a hands off. It was supposed to be just a platform that brings together borrowers and lenders, which is not very risky from Upstart's perspective. Whether or not these loans default, Upstart wouldn't have any exposure to the default rates of these loans. But when Upstart decided to enter and make loans itself is when the risk level of the stock increased and the business model was transformed. It's no longer just a platform that brings together borrowers and lenders. It now turned into a lender, right? It's making the loans. And so now it's exposed to defaults, default rates, and the participation of that business. So it's in a new business now. And that's understandable because if you look in its most recent quarter, total revenue came in at 135 million, which is down by 14%. Imagine if Upstart wasn't participating and wasn't making the loans. Already its lending partners originated 114,000 loans, which was down 34% from the prior year, the same quarter the prior year. So Upstart made the decision to step in and fill that void because they didn't want the other side, the people coming onto the platform, the borrowers who came in looking for loans. If they kept coming in looking for loans and there was nobody there to lend them money, they would probably leave the platform and not come back. And so Upstart made a decision to say, you know what? Nobody wants to make these loans. And so let's step in and make them. They offer us a good risk versus return because since there's nobody else lending here, we can attract higher interest rates by making these loans. I agree with that. That's true. But now you've transformed the business model. And so still Upstart management is saying that that's not what they intend to do longer term. They just stepped in here with the unique circumstances. And when the market rebounds, they'll likely take a step back and allow lenders to take a more pronounced role. However, lenders got a taste for this and they like this. They want Upstart in there because they want Upstart to have some skin in the game. They want Upstart to be exposed to the defaults, and therefore Upstart will be more interested in improving the model, improving the ratings to determine the AI model to determine what interest rates people should pay and who should be approved and who should not be approved. If Upstart's going to be exposed to the losses, they're going to be more invested in making improvements in that model. So lenders want Upstart in there. And so it remains to be seen if Upstart can back out and just become a platform again where it just brings together borrowers and lenders. And that's what I'm looking at longer term. I'm also looking at the effectiveness of this AI model. Upstart has not been through a economic recession where millions of people lose their jobs, which is when typically default rates are at their highest. And that's when you want to compare Upstart's AI lending model with traditional lending models and see which one worked better. Was Upstart's lending model infused with AI better than traditional models during the recession? If so, that will be a big positive for Upstart. That will be a huge positive for Upstart and Upstart stock. If it's even close, it will be a huge positive because by using AI to make lending decisions, you're making it more efficient, faster approvals, and less expensive, less time, less labor intensive to make these decisions. So even Upstart just has to be close to traditional lending models in terms of effectiveness in order for the business to do well longer term, in my opinion. But we haven't seen a recession since Upstart started, really making loans in meaningful amounts. We haven't seen a prolonged recession where people lose their jobs and have lower income and don't have money to repay and start defaulting on loans. So that's what I'm looking at longer term with Upstart. But let's look at the business performance. Look at since January 2021, the company exploded in terms of revenue trailing 12 month all the way up close to a billion. And then, like I mentioned, as interest rates increased, that was a huge negative for Upstart's business. Revenue halved to 515 million. But on top of this, the business risks increased because now Upstart is making a good portion of the loans on the platform. So not only is revenue half of where it was at its peak, but also Upstart has taken on significantly more risk. The company had been making excellent progress. As revenue was growing, they turned net income positive all the way up close to 80 million. That was heading in the right direction very quickly. So it's understandable that a lot of investors got excited about Upstart stock. Not only was it growing at a rapid rate, but it was also generating profitability on the bottom line. That was rare. That was rare. And now it's in a different position, right? Now it's been losing money every quarter for I would say an extended period here. And there is no telling if or when it'll get back to these levels of profitability. But what it did do in that time period is it demonstrated to investors, it showed them, look, if our revenue grows to this level, look at the kind of profitability we can generate. Right? It demonstrated to investors that the business model can generate strong profitability when it's operating at scale. And that scale, that level that they need to reach is roughly the 1 billion mark that they were hitting at the peak. And that's when net profit was also at the peak. So if they can roughly double revenue from where they're at, they can get back to these profitability levels. And in fact, estimates are suggesting that's where Upstart will go. Let's take a look at those estimates instead of just talking about them. Right. So for fiscal year 2024, analysts expect Upstart revenue to grow by 29% for the year and for earnings per share to improve by 119%. They're expecting earnings per share, or we should say the loss per share, to improve from a loss of 58 cents per share up to a earnings per share of 11 cents. So analysts are expecting Upstart to be profitable for fiscal year 2024. And 2025 is expected to be even better than that, with revenue growing 24%, but earnings per share tripling, increasing by 233% from 11 cents a share to 37 cents a share. So the expectations for Upstart are robust. The market is expecting Upstart to recover and recover strongly over the next 2 years and for profitability to improve. So consider that and think about that. That's incorporated in the valuation now. So it's not a it's not a contrarian outlook to think that Upstart is going to improve over the next 2 years. It's the consensus. It's what most analysts are expecting, that Upstart is going to improve dramatically over the next 2 years. And so that's in the valuation already. So that's included in the prospects for Upstart in 2024 and 2025. The next thing I wanted to highlight is average diluted shares outstanding. The number of shares outstanding is an important financial metric. If a company issues more stock because it is running out of money or it wants to invest in a new growth project, it has the potential to decrease your earnings per share. Look up here, when I have a net income of 1,000 and shares outstanding of 100, my earnings per share is 10. You take the net income divided by shares outstanding and you get 10. But now let's say you increase your shares outstanding to 200 and you have the same net income of 1,000. Now your earnings per share is just 5. The same is true in the opposite direction. If a company is losing money on the bottom line and it issues more shares, it spreads out the losses across more shares, thereby reducing the loss per share, which is a tricky way to reduce the loss per share. Look at this point here. A net loss of 1,000 with 100 shares outstanding creates a loss per share of 10. But if you take that same net loss of 1,000 and you spread it across more shares, 200 shares, you now have a net loss per share of just 5. So it's a tricky accounting trick to get your losses reduced on earnings per share. So you want to take a closer look to see where the improvement in the loss per share is coming from. With that being said, you can see Upstart since January of 2022 has been buying back its shares. It's been reducing its share count. The difficulties it had, it realized that the market was not going to be happy with that. I showed you earlier, I talked about the stock price is down 88% off its high. And management looked at that and said, we think our stock is undervalued now. So let's use some money and buy back our shares now that they are undervalued. And so they've reduced their number of shares outstanding. And if or when they return to profitability, as we talked about earlier, you can see that will have a positive impact on earnings per share. And finally, I wanted to look at valuation. And Upstart stock is trading at a forward price to sales of 6.09. That is expensive, and that is significantly more expensive than where they started the year. They started 2023 trading at a forward price to sales of 2.5. That's more than doubled to 6.1. So as Upstart's prospects improved throughout the year, many good things happened for Upstart throughout the year. Number one, the Federal Reserve stopped raising interest rates and kind of took a slower pace of raising interest rates. Number two, Upstart was able to secure more lending partners for the platform. So more lenders came onto the platform as they became more comfortable that the US economy was not going to enter a steep recession. So they attracted more partners, and that was favorable for the business. And so these prospects have helped increase Upstart stock to this valuation. In my opinion, the stock already incorporates that near excellent prospects over the next 2 years. I think it's already in the valuation. So at this point, I wouldn't be buying Upstart stock. I won't recommend Upstart stock as a buy for 2024. Now, this is one where if things improve in the first quarter and the valuation remains the same, then I could see myself upgrading Upstart stock to a buy. Or if things stay the same and Upstart's stock price decreases significantly, I can see myself upgrading Upstart stock. The thing I'm looking for again is for Upstart to add more lending partners so that Upstart itself is not making the loans. They're just becoming the provider of the model, bringing together borrowers and lenders. That's the thing I'm looking for. And the other thing I'll look for is progress on profitability. And of course, valuation. If the price drops significantly, I would be looking at upgrading Upstart stock. If you like the video you just saw and you want to see more just like it, please subscribe to the channel. I can't keep this channel free without the support of viewers like you. And if you're already subscribed, thank you, and I appreciate your support.